Before we get into the one big beautiful bill, I just want to kind of go back and talk about the last 5 years. So the last 5 years have been kind of a whirlwind for everyone. Obviously, we've had lots of changes. And so the last time we had this many changes in tax legislation in a short period of time was probably 1776. I don't think we've had a 6 months where we weren't in the middle of a change, having a change, or talking about one. And so I know from a tax perspective and audit perspective, as well as for a construction owner, CFO, executive possession perspective, it's been difficult to plan. You really don't. Everything changes every time you turn around. What are we going to do? How do we protect ourselves? You went through all the significant inflation. Did my contracts cover price increase? All of a sudden now there's tariffs. There's all this different stuff going on, and so it's been a lot. Specifically in tax with the Tax Cuts and Jobs Act, which we'll get into a lot today, and then the Inflation Reduction Act, and then the one big beautiful bill on top of all the CARES Acts. There's been lots of tax changes, and so we want to go through it. One of the good things about this bill is it provided some clarity, and that was one of the intents of this. So but without further ado, we will get into the one big beautiful bill. It's the greatest bill ever passed. Everyone agrees. Believe him. So there's a lot in this bill. If you go back and remember how this started, there was an intent to get this bill passed on both the House and the Senate on the right with the conservatives. The Senate wanted to do it in two different bills, one for tax and one for the remainder of the priorities. And Congress wanted to do it in one big beautiful one bill, which Trump dubbed one big beautiful bill. Obviously, Congress's intent worked out, and they did get that passed. But this went back and forth for a long time. If you remember, there was lots happened since then. So it seems like 5 years ago, but it was actually a few months ago when they got this thing done, and they were deadlocked. And one thing to know, that this was passed as what's called a budget reconciliation. So it's not a normal bill. So that procedure allows you to pass something without getting to the filibuster, but it's basically a budget reconciliation that has to be budget neutral. This is the same way that Obamacare was passed and lots of other bills, because probably for the last 20 years, Congress has been about incapable of actually passing a bill through the traditional manner. And that'll come into play in the way some of this stuff worked out as well, because in order to get that budget neutral, you've got to get some give and take, some things you have to let expire. This thing went back and forth from the House and the Senate, and at one point it looked like it wasn't going to pass. I'm pretty heavily involved with the legislative arm of the Associated Builders and Contractors, and we were in D.C. back in June meeting with Congress and some of the senators and talking. We were talking with Speaker of the House, Mike Johnson, and he said, we're going to pass this thing on the 4th of July. And I thought he was out of his mind. But in true Donald Trump fashion, he signed this bill in the Rose Garden on the 4th of July. So it is now a bill, and it's now law. And so we're going to get into what that means for you as contractors. We'll also hit on a few other things that aren't necessarily construction specific, but may impact you personally or your employers or employees, or it was just something that was talked about a lot to provide some clarity. So this bill, I'm going to go through the timeline. You can see that it's got 6 chapters. The overarching goals of this from Trump's perspective and from the Republicans' perspective was to provide tax relief for middle-class families and workers, and to provide some certainty for business owners and competitiveness, ability to take some aggressive deductions and make investments, specifically America First. Also to get rid of some of some or all of the Green New Deal spending and get back to an energy secure America, drill baby drill. And then also some presidential priorities, things like no tax on tips and overtime that were talked about in the campaign that he wanted to make sure he came through on. So we'll kind of walk through each of these chapters and the highlights, and then we'll get into some detail on some things. Some others we'll see if there's questions on. All right, so in chapter 1, providing the permanent tax relief for middle-class families and workers. So let's go back to the Tax Cuts and Jobs Act. So basically, the Tax Cuts and Jobs Act, also known as the Trump tax cuts, were passed in 2017. And it was the largest tax legislation and the largest tax cut probably in history, but the largest legislation since the 80s. And so, but as it was a reconciliation bill, a lot of stuff in there was set to sunset. And we've been in the middle of some of those sunsets already, and we're about to get to the end of them when this was passed. So one of the things they talked about was, hey, if we don't pass the one big beautiful bill, there's going to be a $2 trillion tax hike on the American taxpayer, which was absolutely true because of some of the expiration of this. So you can see on here, to the left, you got your individual tax rates, and that the pre-TCJA rates. Those are the rates that were there before Trump signed the Tax Cuts and Jobs Act in 2017. So you can see there was basically from a 0 to about a 3% decrease for individuals at the highest. But that was a significant change and significant amount of tax cuts. You remember too that they changed the C corporations, also had a gradual tax bracket, but he changed that to a flat 21% tax rate, as well as got rid of the alternative minimum tax for C corps. And we're going to get into in a minute the difference of how he reconciled the individual tax rates and then there was significant reduction to the corporate tax rate and what he did to try to equal that out and how that is shows up in the one big beautiful bill. But you can see here that basically the one big beautiful bill did a 0 to 2% cut and made it permanent from what it was before TCJA. So now there's nothing going to fall off the next 5-10 years unless Congress can actually get together and pass another reconciliation, another bill. Those individual tax rates are now permanent. Likewise, you go look at the standard deduction back before the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act basically doubled or more than doubled that, depending on what bracket you were in. And the one big beautiful bill basically made that permanent going forward. All right, so in the same chapter, one of the things they focused on was some ancillary tax credits and items. So the child tax credit and the TCJA was increased from $1,000 to $2,000, but it was not permanent. It was temporary. This bill has now made that tax credit permanent, increased it to $2,200, and indexed it for inflation going forward. So that child tax credit is now there and will go up for inflationary purposes as we go forward. They also increased the alternative minimum tax exemption amounts and the modification of phase-out thresholds. So if you are a flow-through entity, an S corp or partnership, you have the ability to defer some tax if you're a small taxpayer outside of the percentage of completion method, which we'll get into in a minute. But you still are on the hook for alternative minimum tax in certain instances. There were some limits and phase-out thresholds that were in there, and this just increased them and changed them a little bit. So it was a positive change. Alternative minimum tax is one of those really fun things to try to deal with. And if you have questions on it, we can get into it, but it was a positive change, just increased those thresholds a little bit. The mortgage interest deduction, if you remember pre-TCJA, if you had a primary or secondary mortgage, you could write off the interest. One of the things that they did that kind of offset some of the deductions in the TCJA was to limit the interest paid on those mortgages to the first $750,000 of acquisition indebtedness, which meant if you got $1 million loan on a house, you could only deduct about 75% of the interest on that, right? You couldn't just deduct it all like you used to be able to. This kept that and made it permanent in the one big beautiful bill. Similarly, they had put some limits on HELOCs or home equity lines of credit. Used to, you get a HELOC, it's on your primary residence, you can deduct it on Schedule A. Now you have to use it to acquire, construct, or repair, or substantially improve your property. You can't get a HELOC and go buy a yacht and write it off, right? So that they kept that there, made it permanent. And they did bring back the mortgage insurance premium deduction, although it starts phasing out at $100,000 of adjusted gross income, married, filing, joint. So it's going to be the lower end taxpayer that's able to take advantage of the mortgage insurance premium deduction. All right, so we'll spend a little bit more time here getting into some of the meat of this bill. We talked about a minute ago the fact that they changed the corporate tax to 21% flat, but they only reduced individual tax rates from 0 to 2.9%. One of the things that he did in the TCJA was what's called a qualified business income deduction, which is section 199A. You hear it called the Trump business deduction, 20% business deduction. It's got several names, but basically what it allowed for was allowed for most businesses to deduct 20% of the income on their flow through entity, being an S corp or a partnership, for federal tax purposes, to try to basically even out the difference in the corporate tax rate and the individual rate adjustments that were made. This was a pretty significant adjustment that was a very big deduction for contractors. Now there's some caveats. They have what's called a specialty service trader business. Trump excluded those. They still qualify, but they get phased out in income. So those specialty service trader business is going to be a lawyer, doctor, accountant, etc. So apparently he doesn't like us very much. So we don't get to take that deduction like contractors do. Contractors, there is no limit for the SSTB exclusion outside of the normal qualifications in there. But that was a significant deduction, and that was about to phase out. And that would have been a big tax hit to our flow through contractors. So this is a very big deal that they extended it. But not only that, they made it permanent, whereas it would have been gone after this year. So that was a very good, big part of this bill. Likewise, another one, and this you probably heard about in the One Big Beautiful Bill because it was such a big sticking point for getting that bill passed. When they first passed the resolution of the Tax Cuts and Jobs Act, they put a SALT cap of $10,000, which what that meant was, think back to your Schedule A, if you're an itemized deduction taxpayer, used to, if you're an S corp or a partnership and you're paying a lot of income tax at the state level based on your business that just flows through to you, you would then deduct those state tax payments on Schedule A, which was a significant deduction for a lot of business owners. Well, they capped that at $10,000. Well, if you live in California, $10,000 probably doesn't pay for your real estate taxes, let alone your property taxes, let alone your income taxes. New York, New Jersey, same thing. A lot of people said that he did this to kind of take a jab at the blue states because they have higher tax rates for the state purpose. Some said he did it just to help fund the other cuts. Some people believe it's a combination of both. Either way, it was a significant issue, especially if you have a state that has any state income tax, let alone a high one, if you're a very profitable business. So what happened back then, if you remember, was a lot of the states went in and created what's called a PTAT, a pass-through entity tax. They said, okay, we're going to work around this by creating a regulation that allows us to deduct our individual tax liability by paying it at the corporate level. And so they all went out there, not everyone did it, but a lot of states did, and created this PTAT. So that was a whole new way of doing it. You have to make an election, file a different return. And because all the laws were written differently, there's actually some finicky things in the way that you report them, even for financial statement purposes. Some of them have to be reported as a distribution, some reported as a tax. So there's some caveats there to be aware of. But anyway, they've now increased this SALT cap to $40,000. So PTAT is still a great option because that's still an option for all those states. That didn't go away. And if you owe more than $40,000 in state income taxes, you probably want to make that election. But this did allow you that cap to go up to 40. So you don't have to make the election and you can deduct 40 on your Schedule A. Or even if you made the election, if you've got other state taxable items that didn't come from your flow through, you can now deduct $30,000 more than you could have on your Schedule A. So that was significant. And unfortunately, this only goes to 2030. They kicked the can down the road. That was their compromise because one group didn't want it and one group wanted it. So they said, we'll do it till 2030. So something to keep your eye on as we go forward. If that goes away, it could still be a little bit of a problem, but we still do have PTAT. So, and by the way, when you get into PTAT, make sure you're talking with your tax advisor about this when you do your tax planning and fill your return out, because this is an election you can make every year. And there are times when you'll want to make the election and pay it at the corporate level, and there's times when you don't. I'll give you an example. We had a client here in Arkansas, high net worth, had significant income, but probably the last year, we'll get into in a minute, they made significant investment in solar to get some tax credits there. And so they ended up with a pretty good loss in one of their entities that we would normally elect PTAT on. We elected out this year. so that loss would flow through to the personal level because they had about $100,000 in taxes due at the state level from other investments that weren't in that business. And so just got to pay attention, because otherwise they'd have had to write a check for $100,000 and wait on this loss that's sitting in the other entity to get absorbed in the next couple of years. So this is something you want to be talking about every year and making sure you're making those elections correctly. All right, not quite as big of a deal, but still worth mentioning here. So the estate and gift tax exemption, if you go back all the way to 2001, we're talking about George W. Bush here, they had a reconciliation package passed back then that talked about what the estate exemption was, right? The estate tax, people call it the death tax or inheritance tax, but you never really pay tax at the inheritance level. You pay it at the estate level. And it's a significant tax. It's actually 40%, so it's a big tax rate. How much of it gets taxed has to do with the exemption amount. And back then, there was a pretty low amount, and they had it set to increase every year. And they had a temporary, kind of like this other stuff we've talked about, and it was set to expire in 2010. Well, they were like, we'll deal with it in 2010. Well, they couldn't come together. They didn't deal with it, and it expired. And so you might remember the throw mama from the train year. This is the years like, well, if they're going to die, let's let it be this year because there'll be no tax. And so if you remember George Steinbrenner, if you're either a Seinfeld or a Yankees fan, he died back in 2010, significant net worth. He didn't have to pay any estate tax because they accidentally let it expire and there was no tax. It went back, they fixed it in 2011, and it was, I believe, $5 million indexed for inflation, which is where it was. You see here the pre-TCJA number, 5.49 million. So that's where it had gotten to. The Tax Cuts and Jobs Act basically doubled it at that point in time and then indexed it for inflation. So it would have been 13.99 million in 25, or that's what it was for the Tax Cuts and Jobs Act. The One Big Beautiful Bill Act increased it to 15 million, made it permanent, and indexed it for inflation. So now we're not worried about schedules or the mama from the train years or all that. It is what it is unless they pass additional legislation, and it's going to be indexed for inflation. Now it's 15 million per taxpayer. So married, filing, joint, you actually have $30 million of estate that you can leave to the next generation without paying estate tax. But if you are anywhere in this realm, you need to be thinking about estate planning, because again, that tax rate's 40%. It's worth looking into. And if you have a valuable construction company, it may be worth, you may be closer than you think to what that number is, and it's worth looking into and planning. So speak to your attorney, speak to your accounting advisor, your tax advisor, and make sure that you're making appropriate plans for that. All right, so now we're into delivering on presidential priorities. So this gets more into the Trump specific parts of the bill, right? Starting with tax on tips. So apparently Donald Trump was on the campaign stop, and a waitress came up to him and said, you should not have tax on tips. And Trump said, oh my gosh, that's the greatest thing I've ever heard. No tax on tips. And he started saying it, and here we are with no tax on tips. It became a big campaign message, and in true Trump fashion, he said it, so he was going to make it happen. So he made sure that this was in the bill. So like anything with tax, though, it's not clean, it's not easy, it's not just they're exempt. There's some caveats here. Again, this probably won't impact you, but just in case anyone asks, or you know someone that this does apply to, basically there's a deduction for eligible tips that you have to get a statement from your employer showing that, and it includes cash, credit card, and tip sharing, but it's capped at $25,000. So you can take up to a $25,000 deduction for qualified tips. If you're a business owner, it gets limited to your profit. You can't create a loss with it. Again, same, especially service trader business exclusions in there. It does not count. My guess is that they realize that if you give an accountant a loophole, we will utilize it, and you would have been paying your lawyers and accountants in tips starting in 2026 is my guess. They went ahead and headed that off at the pass so they didn't have to close that loophole. So unfortunately, those billing practices will not change. And this does phase out at AGI of 150,000. Again, it was geared more towards the lower middle class and lower class earners to try to give them some tax relief, and it is only effective from 25 to 2028. So it will go away if nothing else is done. All right, priority number 2, you heard this, and this is going to be, closer to home, no tax on overtime. So he hit this just as hard as no tax on tips. It was a big part of his campaign, so he made sure it was in the bill. And again, not quite as easy as you would think, but it is there and it's real, and it will be helpful for those people making overtime income. So basically what happens is there's a deduction allowed for qualified overtime compensation under the FSLA. But it only applies to the half of the time and a half. So if you make $20 an hour and you work overtime and you get 30, it's only the $10. It's not the base pay, and it's not the 20 hours on the overtime hours. It's just the half. It's limited to 12.5 per taxpayer or 25,000 married, filing joint, and doesn't include tips. The phase out similarly to tips starts at 150,000. And if you are married, you have to file joint if you're going to take this deduction. And just like the tips, it's only set to go through 2028, and it expires if nothing is done. And employers are going to need to report this on your W-2. I believe it's going to be box 14. But there will be some increased W-2 reporting for that, just so that they can get their tax returns prepared. So if you have questions on that, feel free to ask a question in the Q&A or reach out to us via email, and we're happy to help you with that if we need to. All right. This one, not as much for contractors, but it was talked about a lot, so we figured we just hit it real quick. No tax on car loan interest. So in the vein of the fact that everything's increased price-wise, especially vehicles, and interest rates are up, in order to try to provide some tax relief for families, they did pass the ability to deduct interest on qualified passenger vehicle for personal use. So this only applies for personal, does not apply for business. And whether you purchase it or it's a lease financing, it does qualify. But it's only on qualified vehicles. What is that? It's a vehicle that's final assembly was in the U.S., right? It's part of the make, America first. Doesn't have to all be manufactured here, but final assembly does have to be here. And it has to be new. You can't go buy it from your brother, your sister, or anyone else for used and then go get that. So you have to buy a new vehicle that was final assembly in the U.S. And there'll be a statement that comes out from your lender that will dictate whether it qualifies or not, similar to a mortgage interest statement, so that you can prepare your tax return with it. It's limited at $10,000 of interest expense per return, so it doesn't matter if you got 50 vehicles or one vehicle on your tax return, you get $10,000 you can deduct. But this is also allowed whether you itemize or not. So even if you don't take standard deduction, you could still get this deduction, and that could be significant for some lower middle class taxpayers. And phase out of this begins at 100,000 of income, 200,000 adjusted gross for joint. All right, so this is one that it's kind of a big deal in the bill, but it was less touted. People know less about it than they do some of these other areas. So this is what's called a Trump account for children. So basically, this is an IRA-like account that they allow for you to have for your children to build some wealth for them. That's also treated like a Roth. The growth is tax-free. When I first heard this, I just assumed with Trump that the only thing you'd be able to buy in the Trump account was real estate, gold, or Bitcoin. However, there's no requirements like that. You can invest in it just like you would any other retirement account. So this could be a significant thing for you to add on to your children, grandchildren, just like a 529 college savings plan. So something you definitely want to talk to your investment advisor about. If you have one, if not, reach out to us. Happy to get you in contact with one of our wealth advisors that can go over what this means. So this will not start until after 4th of July, 2026. So again, in true Donald Trump fashion, it starts on the 250th birthday of America. The Trump accounts will go into effect. Again, like it says here, this aims to encourage long-term savings and investments for minors. And this is supposed to give them another option besides Social Security, right? And so it could definitely be a good thing. The accounts have to be owned by the child, and it has to be set up as a Trump account from the get-go. You can't change one. So you'll need to make sure you go through those motions with your advisor. There is a government-funded pilot program that will provide up to $1,000 per qualifying child that is born between 1/1/25 and 12/31 of 28. So again, I encourage you, if you've got children, grandchildren, look into these. Definitely could be some opportunity to build some wealth and have some tax-free growth for them going forward. All right, getting into the establishing certainty and competitiveness. So this is more geared at the businesses and allowing them to be aggressive with investment, specifically in America, as well as being able to plan and know what's coming instead of trying to figure out what you can deduct every year, which was causing a lot of trepidation, and a lot of people were keeping their powder dry, not doing a lot, not buying equipment, not making investment, because they just didn't know what to expect. And so they really wanted to give some clarity and some ability to take some aggressive deductions and put that money to work for investment, because that's what this administration, right, wrong, or indifferent, has been pushing for. Is we want people to invest and go big in America, because they believe that will pay dividends. So with that, they tackled a couple big things in here. Bonus depreciation was one of the biggest parts of this bill. So what is bonus depreciation? Let's go back again, pre-Tax Cuts and Jobs Act. There's bonus depreciation and there's 179, and they are different. They're both methods of accelerated depreciation outside of the standard makers double declining balance tax methods over the useful lives of your asset. Allows you to take immediate deduction for those types of property placed in service in that year. 179 basically you could use it on new used equipment back then, and there were some thresholds of how much you could place into service, how much you could deduct. But it gave you that ability to deduct it at 100%, which is significant. And then bonus was only on new equipment. It wasn't used. It had to be new, and it was only 50%. Well, when Trump passed the TCJA, he made it 100% bonus, which was huge, because then all of a sudden you can buy this equipment and write off 100%. You didn't have the threshold phase outs. You have 179. Some of the state exemptions to 179 didn't apply. And so it was a great tool for investing and taking deductions and putting that money to work for you and your business and not giving it to the government. However, like everything else in the Tax Cuts and Jobs Act, because it was a reconciliation, it was set to expire, right? And I believe it was 40% for 2025, and it was set to be gone by 2027. The One Day Beautiful bill made bonus depreciation permanent. So now we have permanent bonus depreciation with no limitation. You buy equipment, it meets the requirements, you take 100% deduction now, and we're not worried about it going away, which is huge. And that's new or used equipment. So this gives you it's a lot more flexible than 179 and gives you some ability to take some aggressive accelerated depreciation. So a big part of the bill. With 179, it's always been there, but they did increase the amount of 179 you could take to 2.5 million, and they increased the phase out threshold of how much. That's based on how much equipment you place in service that year. They increased it to 4 million, so you didn't get quite as hampered by that. Now these thresholds were made permanent and will be indexed for inflation going forward. It's important to keep in mind that when you look at this this is an every year analysis and election situation. You can't just get on autopilot and say, well, it's bonus up. Yeah, we're 179. You can use both of them together. You can use one or the other. Now, the way it works now is you are in bonus depreciation unless you want to elect out. You can elect out based on asset class, 5-year property, 7-year property, and it's an annual election, right? Or you can keep bonus and you can take 179 on certain pieces and even for certain amounts, and then bonus the rest, or take 179 for a certain amount, like that a bonus for an asset class. Why would you do that? Without getting too deep in the weeds, there are situations where you may want a deduction hung at the business level, which you can do with 179, not with bonus. So there's reasons to use one or the other or both together, and you really need to be looking at this every year with your tax advisor. If you're just going through you may be missing something, right? You need to make sure, hey, look, we've got these tools. There's some elections we got to make. But let's talk about what makes the most sense now and in the future to minimize our tax burden. Because if you're not using these tools, you could be missing something big, and you'd be surprised how many times we get returns and we're looking at stuff and there's just missed deductions, and we're just paying more tax earlier in life than we need to. And with time value of money, that's a significant drain on your cash flow. So make sure you're getting into that and you understand it. And I'm sure there'll be some questions around this. We can hit on more, but that's the broad strokes of bonus in 179. So that was a big part of the bill. Very excited that they did make it 100% and it's permanent, because that's a great tool for tax planning. All right, qualified production property. What in the world is that? Good question. It didn't exist until the One Big Beautiful Bill got created. So what is now dubbed as QPP, qualified production property, was a something Trump put in here, aiming to bring manufacturing back to the United States. Right, that's one of the things he wants to reshore the manufacturing that was sent overseas, based on a lot of the trade policies and things that have been done in the past. Why are we talking about manufacturing? This is a construction webinar. Well, it could impact you because A, you might be building some of these, or B, like some of my clients, you may have a manufacturing related entity that's integrated into your business that qualifies for this. And this may be an opportunity for you to save some tax. So if you think about real property in general, or looking at real estate, you can't just deduct the building, right? You've got to deduct it over 30, 39 years. And unless you want to do a cost segregation study, without getting the weeds on that, we can talk about it in the Q&A. Cost segregation studies, where you go in, you do a study on a building and you break the building into its component parts and different asset classes, and some of those will be eligible for accelerated depreciation. And so we're able to go ahead and take those depreciation amounts now, as opposed to 39 years. But outside of that, you were kind of stuck on the building envelope being that longer depreciation. This allows you to actually write off a building, right? I mean, in its basic terms, if you have manufacturing property that qualifies and is an integral part of qualified production activity in the U.S. or in the possession of the U.S., you can take bonus depreciation on this entire building if it was the construction started after 1/19/25 and it's placed in service before 1/1/2031. So it's basically a 6-year window in there to get this thing built. It has to be built. You can't go buy a building and say you're manufacturing, write it off. You got to go build a qualified manufacturing facility. And if you do and you meet the other requirements, you can deduct the entire thing in the year it's placed in service. So if you're building a $3-4 million building, like I've got some clients that are doing that for other ancillary items, you might be able to deduct that in that year. And that could be a significant amount of deferred tax that you can use that cash to invest in your business. So if you are doing anything remotely like this, make sure you bring this up to your tax advisor and you're evaluating it. One other thing to keep in mind, you have to make that election. This is not something you just do. There's actually a specific election you make on your return that you'll need to do. All right, so again, certainty and competitiveness, we're talking about R&D, research and development tax credit. So I'm sure several of y'all on this call are used to these or doing these right now. You've got qualified R&D activities, and as such, you've hired someone to do the R&D study and go take the R&D tax credits, and that's great. And if you haven't done that, you might want to just reach out to your tax advisor and say, hey, do I qualify for this? But basically, until a couple of years ago, you could, if you had qualified domestic research and development expenditures, you got to write them off, but then you got to also capture them up and do a study and take a tax credit for them. So you kind of got your cake and got to eat it too a little bit. Well, it was inadvertent, I believe, in the Tax Cuts and Jobs Act, the way that they wrote it, it kind of left it in purgatory, and it reverted back to where all of a sudden you couldn't deduct the expenses. Excuse me. You had to capitalize them and deduct them over 5 years. Well, that wasn't as beneficial, obviously, especially if it's a lot of expenses. You still got the tax credit, but not the deduction. So anyway, it was kind of also challenging if you had some contracts going over 2 years, it could have been a situation you had to deal with the way that you have your job costs and allocations. A couple of years ago, there was bipartisan support to try to pass a bill to get this done. But like everything else in Congress, nothing happened. So it didn't get done until the One Big Beautiful Bill. When it passed, they basically brought back full expensing of domestic research and development expenditures and the tax credit beginning after 2024. If it's foreign R&D, you have to amortize them. Now, another important fact, they allowed some fixes for this to catch up some of these expenses that were capitalized. So if you're a small business under Section 448C, which is the same exemption for whether you can be cash basis or have to be percentage of completion, if you are that, if you qualify as a small business, you can go back and amend 22, 23, and 24 and take those expenses and maybe able to get some tax back. So if you've been doing R&D the last few years, you need to talk to your advisor and see if you can go back and amend. If you're a large contractor, large business, you have an option to either expense everything left over 1 or 2 year period going forward, which will depend on what your tax year looks like, whether you have big taxes due. If you had a lot of tax you paid in the last couple of years and eligible, you probably want to go back and get it. If not, and you have a huge year this year, you probably just want to use it all this year. So that's an analysis and election that you can make at that time in conjunction with your tax advisor. But again, this is something that was up in a big issue for a while. Everyone wanted to fix it, but nothing ever happened. So it was a big deal to get done. And there's some big benefits on this, or can be. All right, 163J. This isn't going to affect everybody, but this is 163J is the business interest expense deduction limitation. And so up until the One Big Beautiful Bill, when you calculated how much you could deduct, you had to use EBIT, which is earnings before interest and taxes. But now they made it EBITDA, which means you can now add back depreciation and amortization to your qualified income to calculate how much you can deduct, which will increase your deduction usually. So that was a positive change, really, for real estate activities. It's really going to help them a lot. So just keep that in mind. If you have a 163J issue, it could definitely be a beneficial change for you. All right, getting into investing in American families, communities, and small businesses. Small things here. Back before the TCJA, you had a child tax credit. They bumped it up to $1,000 per child. And then the One Big Beautiful Bill basically made it $2,000 and then made it permanent, right? So now we know it's not going away, and they increased it some, so that was positive. Likewise, on charitable contributions, they basically said, hey, there is now a 0.5% floor on your deduction, right? So they did increase. Actually, I'm sorry. Let me go back. So the 2,000, that was actually for the deduction that you can take if you don't itemize. So I got ahead of myself. I'm on the next slide. So basically, if you used to, you couldn't deduct charitable contributions if you did not itemize. If you did the standard deduction, they did it to where you could do 1,000. Now you can do it 2,000, even if you take a standard deduction, and made that permanent going forward. Excuse me. Likewise, they did, though, add a floor to individual deductors of contributions. So what that means is if you make $100,000 of contributions and you're going to deduct it on your itemized Schedule A, the first 0.5% is not deductible for individuals. And for if you're a corporate, it's 1% floor. But they did extend the 60% limit of your taxable income going forward. That's where it's at now permanently. So a few changes there, some good, some bad. All right, small business stocks. This is the 1202, section 1202, small business stock gain. So people are probably familiar with this. If you met certain qualifications as a small corporation, you could sell the stock of your company and pay no tax on the capital gain, but you had to hold it for 5 years. The only change here is instead of having a cliff vesting in 5 years, and went back and added a couple stair steps of vesting in there, 50% at year 3, 75 at year 4, and then again, 100 at 5 years or more. So if you qualify for Section 1202, there can be some significant tax savings if you do it as a stock sale, not an asset sale. So if you are a corporation and you've got a sale coming, you may want to talk with your advisor about whether or not you qualify for this and what that can mean, especially when you're looking at negotiating whether it's a stock sale or asset sale. All right. So investing in American families continued here. So this is just a housekeeping item. The 1099 limit's been $600 for a long time, and inflation obviously has been a lot in the last 5 years, especially. So let's up this to $2,000 in its index for inflation going forward. So it takes a little bit of the 1099 burden off the companies out there. All right. New Green Deal spending. We won't get into this. There's so much going on, and there's so many different dates and the way that they do this. We can talk. If you have specific questions, we're happy to take those here in a second. But basically, most of the green energy provisions out there are going away, right? And so just be aware of that and know that if you have one going or one planned, they are probably going away. And some of the expiration is triggered on placed in service, and some is triggered on the beginning of construction. So you just need to know which one that is so you understand whether you actually can get these credits or not. But again, most of these, not all of them are of the green energy credits are going away. All right. One more housekeeping on it before we go to Q&A here is the employee retention tax credit. If you remember back to CARES 1 and the COVID era, which probably we don't want to, it was not that fun, but they came out with PPP, the Paycheck Protection Program, which was the loan that you could get forgiveness that was tax-free. They also had this. Well, unless you were an employer of a lot of low-level wage earners, like a big restaurant chain, ERTC didn't make sense. You couldn't get as much, and it was taxable. So everybody did PPP. Well, then CARES 3 comes along and says, you know what, you can do both of them, right? But ERTC is taxable. So people started going to qualify for these, even though they'd already gotten PPP. And it was very lucrative. And we did a lot of them for our clients, and they met the qualifications. And even though it didn't make a lot of sense, it was what they're eligible for. And so there was a lot of that going on. But you probably were driving around your car and hearing somebody talking about you qualify for $16,500 for per employee per quarter, and call me and we'll get you all this money. Well, a lot of people fell prey to that, and they called these people and they charged 20% of the credit, and they just filed like you're eligible for every employee you had, regardless of whether they actually qualified or not. And there was a lot of fraud with that, and a lot of people got in trouble and are still getting in trouble. And basically, this bill came out and said, hey, ERC's done now, and you can't, even if you qualify, you can't file anymore. And because of the issues, they extended the statute of limitations to 6 years to give them time to check into it, and they increased some penalties for promoters. So if you filed this and you qualified, did the right things, nothing to worry about. If you qualified but didn't file, you can't go back and file now. There was a time when they were still paying some of the late credits, or they stopped. Then they started back. Now with the shutdown, we don't know. So if you're still due one of these refund claims, good luck getting an answer, and you may get it next week. It may be 10 years. I don't know. But yeah, the government shutdown is also going to affect some of your refunds, other things like that. So just keep that in mind as well. But with that was a lot, but we do have some time for some questions. So, we can ask questions here. You can visit us online or on LinkedIn, this QR code. You've got my email from earlier in the presentation. You have this email as well. I would love to hear from you, connect with you on LinkedIn. If you have any questions or we can help you in any way, we'd be more than happy to. And with that, I'll turn it back over to you, Brian.
Wow. It's a lot of information. We have a lot of questions, so we'll jump right in. Appreciate everybody attending and being engaged and asking these questions. So we're gonna get through as many as we can here. I know we're pushing time limits, but we'll stick around and do what we can. First question is, are you able to treat exempt employees like computer, office workers, et cetera, as non-exempt so that they can take advantage of the overtime wage exemption?
It's a good question. You have to fall back to whatever the regulations are on that. I don't have a exact answer for you on that one. If you'll get me their contact information, Brian, we'll look into it. We'll get them an answer.
Absolutely. This is Nathaniel. I'm not even going to say the last name. Knur. Maybe Nate, if that's what you go by, if you can take Mark's information, you might be able to best to follow up with him directly on that question. We'll move on to the next question. Let's see. Will there be a segment where Foundation will discuss how they are handling and reporting these changes? At the moment, no, there's not. I don't know programmatically how this is happening. Obviously, this pertains to wages in 2025, particularly the overtime changes, and it is a complex calculation because it's only for hours worked over 40 and the premium portion of those overtime earnings not being taxable, et cetera. So there's a lot of work. I actually just talked to a developer today who's working on developing a temporary report to actually be able to calculate that. And at that point, once that's done, it will be determined, I guess, how it reports. So stay tuned for that. There will be a year-end webinar that's coming out. Probably want to sit in on that as well. But again, I don't know the degree to which that's going to be discussed. But we're very aware and we know what needs to be done. So I guess a follow-up question to that would be, do we know what code to use for the overtime in box 14 yet? Mark, I don't know that offhand. Do you?
Off the top of my head, I don't know that. But again, we can, if that's been clarified, we can get you an answer.
All right. Next. Is this a deduction to taxable income? Where is the car loan interest reported on a return? That actually was answered online. So I don't think we need to address it. The answer to that is the car loan interest will be an above the line deduction that will reduce your adjusted gross income. There will be a new Schedule 1A for 2025 that will be the form to report this deduction and a few others related to the One Big Beautiful bill. So that was the answer to that question. Next. From Scott Oduchowski. How are you, Scott? When I print my W-2s from Foundation, will the overtime pay show in box 14? Is there a setup needed to make it do so? Scott, as I mentioned in the last answer on this, I am not certain how Foundation is going to handle this, especially retroactively for 2025. Obviously, the wages and everything were calculated as taxed, as was the norm. So programmatically, I'm not sure how they're going to handle it moving forward into 2026 in terms of calculating it during the running of payroll, as well as retroactively for 25, how it's going to be reported back onto W-2s, et cetera. So I would say keep an eye out for the announcements on the year-end payroll webinar. Chances are it will be discussed there, but not certain 100%. Moving on, do union workers fall under, this is already answered as well, but we'll at least discuss it. Nope, that's not the question. For everyone attending, just know that the way GoToWebinar handles questions is confusing because as they come in, it automatically scrolls back to the top and I'm going down to the bottom to get the first question. So another question just came in is, do we know what code to use in box 14 for overtime? That was already answered. Keep them coming. All right. Do union workers fall under FLSA for the no tax on overtime deduction? That was answered as well. Union status alone does not affect eligibility. The key factor is whether the worker is non-exempt and the overtime pay is required by FLSA. So moving on. Moving on. Let's go with some that are not answered yet. QPP, what if an outdoor manufacturing facility, construction equipment like stone crushing, would the property purchase qualify?
I don't know the answer to that question. Leslie, if you're on, Leslie runs our specialty tax team for construction, and she's done some research for me on this, but this is still relatively new, and we haven't dug all the way down in there. But Leslie, if you've got some general guidelines here.
Yeah, Mark, trying to kind of pop in and answer some of these questions behind the scenes. I'm having trouble keeping up, but absolutely, when the stone crushing, I would say likely it would qualify. Still waiting for some guidance from the IRS regarding exactly examples of things like that, but that does tend to stray more into, you're getting into production or manufacturing. So I would say likely that could qualify, but more to come, and we'd have to dig into it a little bit more. But that would be a good example of something that I think could qualify.
Yeah, and again, on that too, one thing to keep in mind: anytime Congress passes a bill, a lot of times they'll pass it and it sounds great till you get into the details, and then trying to figure out the IRS's stance on that. They got to come out and give clarification. And so some of these things will pass and no one really knows what to do with it yet, and they'll have to figure it out. This happens with GAP as well. They'll give something just kind of like we're having the retainage and some other debates for that. How are we actually going to do that? We have to kind of see what comes out, what the IRS stance is. But that's something we can dig into more for you. But we're also waiting on some clarification and some examples to come out because it's so new and out of the blue.
All right. I'm actually just responding to one right now. All right. So there's a lot out here.
Yeah, I guess, Brian, real quick, there've been lots of questions about the W-2 reporting. I'll just clarify what I know from what the IRS communications have been on 2025 W-2s is, so for 2025, they're saying box 14 is where you should provide it. If you process payroll, et cetera, box 12 is the one that has all your codes, like your code D for your 401k, et cetera. Box 14 is more informational. A lot of that doesn't necessarily flow automatically into your tax return. It's just informational. And so that's why they're suggesting box 14 for overtime for this year. They've also come out with a little bit of guidance on how to report either overtime or tips. And they're not going to revise the form for 2025. That is coming for 26, is what they're telling us. And they've also said that there will be some grace or some kind of safe harbor if you make a good faith effort to provide that information to your employees, whether it's in box 14 or if you provide a statement to people reporting that their overtime pay that qualifies. There's some flexibility for 2025. And so that's what I will say from the tax. Well, I know that this is going to be kind of messy for 25, and we'll expect more clarification and more standardized reporting for 26. But it's going to be kind of the Wild West for 25.
Great. There's another question here. It says, our workers are paid overtime for anything over 8 hours per day, even if they only work one day. For example, 10 hours, 8 are paid regular, 2 are paid overtime. Saturdays are always overtime. Sundays are always double time, no matter how many hours are worked during the week per their union contract. FLSA is based on overtime after 40 hours worked in 1 week. There's not a question there, more of just a statement, but that does speak to the complexity of the development, and it has to be done on our end to even handle this, to look at total hours for the week period. If it's not in excess of 40, the overtime and everything is going to be taxed. And obviously then if there isn't, or if there are hours over 40, going back then to look at the actual hours until they hit 40 to then determine which overtime portions are not taxable. another time when I am very happy to not be a developer.
Yep.
All right. Let's keep going here.
They just pass bills and leave us to figure out all the details is what they do.
Right. If half of these people making these laws had anything to do with accounting or software, none of these things would ever happen.
Yeah, it'd be a flat tax rate.
Getting paid would be super simple. Prevailing wage wouldn't be a thing. It would be very, very simple. So speaking of prevailing wage, another question here, overtime pay. This also applies to prevailing wage for the exemption. I don't see why it wouldn't. As long as they're hitting 40 hours. The complexity there is which hours are being paid overtime, right? I know a lot of people would like to defer the overtime hours to non-prevailing wage hours later in the week, et cetera, but that's just not how it is. The hours occur where they occur. They're paid overtime on the earnings at that point in time. So absolutely, if prevailing wage is paid, the guy's working later in the week and those hours exceed the 40, then the premium portion of those overtime earnings on the higher wages are the ones that would be exempt from the taxes. Is that your understanding?
We've not gotten that kind of clarification. And so they're going to look at total hours. And I mean, that's a really good example of these specific things that they don't think about when they're passing no tax on overtime, right? I mean, it's just a half. Well, half of which one, right? There's different rates. So again, those are something I want to get our payroll team pulled in on and dig through the rags. But I don't know how they're going to treat that off the top of my head. It's going to be a fun year, like every year for the last 5 years.
You use the term fun loosely, Mark.
Somewhat sarcastically. But in all fairness, there's a lot of good stuff here that's going to provide a lot of good tax relief for a lot of people. And so, those things are when, even though it's complex and a lot of new work, it is fun and we can definitely get some benefits to folks. Some of these are going to go the other way and not be fun on top of it. So it just kind of depends on the situation and what side of it you're on.
Yep. Not sure about this question, but it says anyone making less than $2,000 does not have to receive a 1099. Is that accurate?
Yeah, so that's regarding the reporting. We right now 1099 miscellaneous or 1099 NECs, they've been, if you pay someone or an entity that's not a corporation more than $600 in a year, you got to send them a 1099.
Yep.
Starting with the 2026 year, that threshold's going up to 2,000 and will be indexed for inflation. So if you've got an independent contractor that you're paying less than 2,000 a year starting in 2026, no longer required to send them a 1099.
Until they hit 2,000.
Yeah, it should ease the compliance burden with those 1099s. It is the idea there.
Yeah, no kidding, and certainly a benefit.
Yeah, absolutely. $600 now is not what $600 was whenever that was written. So
no, definitely not. All right, for bonus credit, does that include vehicles, like vehicle bonus?
So I think this is talking about bonus depreciation was when Mark was talking about bonus depreciation and we've got 100% deduction. That's a nuanced question for vehicles. There still is the requirement for luxury autos or listed property, and luxury autos does not mean if it's a Mercedes or not. But typically your vehicles that are over 6,000 pounds, long beds, etc., 100% bonus is going to apply to those, but some of your, if you've got salesmen or something with passenger autos, there's different bonus parameters. You're still going to be limited per year, but it's like back in the day it was 11,800 was your bonus limitation. So there are still some limitations on autos, but there's good opportunities there. And your big trucks and things, you're going to get 100% of those.
Yeah, and there's definitely still the 179 limitations on SUVs and stuff like that. So there's like with everything in this industry, it depends on the details, but it's still overarching, a lot more flexible, a lot better. There's still some caveats, but yeah, to Leslie's point, you're buying vehicles for your fleet. You know, they're over 6,000 pounds, 100%.
Got it. How about will the no tax on overtime for 2025 be reported on the 2025 W-2? And if so, is Foundation Software prepared for that? That is the really good question. I would have to say, I think as Leslie, you may have pointed out, that there's going to be some grace given here, whether the number is reported on the W-2 or if it's just like a statement. And so what I understood, just talking to a developer earlier this morning, was that he is now tasked with creating a report that will report the amount of overtime premium dollars earned for hours worked over 40 in a particular week. I don't know if that is a temporary report that's going to be added to the software to be produced and given to the employees along with a W-2, or if that will be worked into the W-2 for 2026 or not. So there's a lot of things that remain to be seen with how this is going to be handled moving forward. 2026 will hopefully be much easier until they change the law again. Another question here. Federal overtime definition is over 40 hours per week. California overtime is over 8 per day. If an employee works 42 hours, and in California, 5 of those hours are overtime, how will the overtime rule be applied? Again, the overtime rule, to my understanding, right, only pertains to the hours over 40. So they'd only get the tax exemption on the premium portion of 2 of those hours.
Yeah, this is going to be federal anyway, so it's going to be applied at the state. The state differences should not matter in the way that the IRS applies this. I wouldn't think.
Which is something I never even thought about. States are not necessarily observing the same rule for overtime earnings, right?
Yeah, and that's the same thing as ones like here in Arkansas. They don't, there's been differences in the way they do 179 expenses. So a lot of states will either adhere to Fed or they won't adhere and they'll have their own deal. And so every state's different on what they do. And what the IRS does is just for federal tax. And then your state will determine what you can do for state purposes.
Right. So related, we may have kind of talked about this already. Are union employees included in the overtime deduction if they have achieved 40 hours per week per the law, or are all union employees considered to be covered under the collective bargaining agreement and not eligible? I would imagine, union, non-union, doesn't matter. Over 40 premium portion of overtime becomes exempt from tax. Is that correct understanding?
Yeah, again, I'll have to look into that to know for sure, but I would think you're right, but I'm not positive on that.
All right. 1099 miscellaneous limit increase. Does that also apply to royalties in which were previously required at $10?
No, I think that'd be totally separate. This is on what the requirement is to the employer to provide. Because again, if you were not a corporation and you paid them over $600 a year, you had to provide a 1099. That was so the government could make sure you weren't, people weren't not reporting their income, right? Sole proprietors, independent contractors. And so now all they did, nothing has changed except you don't have to do it unless it's 2,000. Right, that's all the change. Royalties would have nothing to do with that.
Right. Yep. All right. I would like to know more about stock sale versus asset sale of corporation. Just a quick overview would be helpful.
Yeah, so, and there's a lot of complexity here, but when you get into looking at M&A, looking at selling or buying a business, right, you get into what's called purchase price allocation, which can have some significant tax implications, right? Whether something's coded as an asset or goodwill, and that's when you're doing that, and that's when an asset sale, right? And when you want an asset sale for a couple different reasons. Um, Generally speaking, you buy a corporation, buy their stock, buy the units of an LLC, any liability, any tax burden that was not paid, you're assuming that, right? Like when Elon Musk bought Twitter, he bought the stock. He assumed everything in there, right? I mean, that's what happened. If you go by the assets and the name, you have a new entity, right? So I might, Leslie might own ABC Construction Corp. I go buy the assets. I can keep the name ABC Construction Corp. And I can start up Barnett Construction LLC that owns that entity. I just bought all the assets and I bought the name, right? And then I'll determine, and part of the negotiation is what is assets, what's goodwill. The buyer wants it to be assets, generally speaking, because you can take accelerated depreciation on and write off all the equipment the year that you buy it. So you get a bunch of deductions. The seller wants it to be goodwill, right? So they get capital gains tax on that. Now it's very, very high level. There's some caveats. I'm not trying to get all down there, but if you you have no liability whatsoever for that entity because that entity still exists, right? She still owns that stock. So I don't care if she didn't file sales tax returns. I don't care if she has any corporate tax that's due. It doesn't matter to me, right? Whereas if I buy that stock, the company's now mine. Anything that she did prior to that is now my problem, right? I got to deal with it. And so if I don't want that liability, then I don't want to do a stock sale. Now there is some, and I can let Leslie talk about this. There is some tax elections you can make to treat a certain sale like a different method to give you some tax benefits. It's kind of a hybrid method. Leslie, I don't know if you want to talk about that real quick.
Yeah, yeah, just as there is the advantage to perhaps buy an asset versus stock because you're cutting off that liability limitation. Sometimes we actually do want to purchase that stock because maybe there's contracts or agreements or something that are associated with that entity, and that's what we want to buy. And so we do want to buy the stock so we don't have to go through the hassle of renegotiating all of our contracts, etc. There, you may have heard 338H10 or 336E. Those are the code sections that govern it. But basically, what that allows you to do, and both parties have to agree, is you can buy the stock of a company and you can elect to treat it as an asset sale. And what that does is it gives you the ability to purchase the assets and get the deductions up front as opposed to just buying stock that is just your investment. You don't get any depreciation. So the seller has to agree. It can't just be one-sided, and so there's push and pull there because it changes how the seller is taxed as well. But a lot of times there's mutual agreement there, and it can be a win-win for both sides.
Yeah, the government's going to get their tax one way or another, right? It's just who pays it, right? That's part of the dance of the negotiation of your buy side, sell side due diligence to get the close there. And there's also, an F reorg. A lot of you can do with that, right? I mean, we've got a contractor right now that we're working with, pretty significant contractor selling to another entity, and they are doing the reorg because they don't want to repaper everything because they've got $100 million of contracts in progress right now. They're not trying to go in there and get those contracts re-signed in the middle of it, right? Not to mention everything else going on, all the other agreements they have. And so there's different options there that you can look into, but depending on which way you go, but really there is an asset sale, a stock sale, and then there's some different accounting and tax gymnastics you can do to bridge the gap there. But by and large, high level, stock sale comes with liability. And there's really no purchase price allocation. It's all goodwill to the owner, and the owner may be eligible for that 1202 small business stock gain exclusion we talked about, whereas an asset sale, there's no liability. You're just buying the assets and the goodwill, and then you got some purchase price allocation to dance around to see what the deductibility and taxability is going to be to either side. And again, you have those different methods that you can utilize in certain circumstances. Oh, and you have to repaper everything in an asset sale.
Yep. So changing gears a little bit here, are employers able to contribute to a Trump account as an employee benefit to the parents?
So I had to go ahead, Mark, if you.
I was gonna say, I believe they can based on some of the data that I've seen, but I don't have any details on that yet. And as they've not started yet, I'm not even sure they really have the parameters lined out. They might, but I have not gotten into them because it's not coming up until next July, right? So I would, but based on the information they gave us, and you look at the slides, it talked about the employer contribution max. Was it like 2,500? Is that what it was?
Yeah, I just looked it up real quick, and it'll work similar to like your dependent care assistance programs and things like that. You'll have to have a separate written plan to do that, but there will be some ability to do that.
Yeah, so the limit looks like it's 2,500 and index for inflation beginning after 2027.
Got it. All right. So for the overtime exemption, is the $12,500 limit referring to the first $12,500 of overtime wages earned in qualifying overtime hours, or is it $12,500 tax savings limit?
I think that's the max that's exempt by taxpayer. It's 12.5 or 25, 25,000 married filing joint. But that's the amount. That's the if you make 100,000 as an individual in overtime because all you do is work, you can still only exempt the 12.5, right?
Yeah, the way it will work for tax reporting purposes is, we're calling it no tax or an exemption, but the way it will be reported on personal tax returns is as a deduction. It will be an above the line deduction. There's actually just in the last 10 days or so, they did release a draft form of Schedule 1A where you will report the amount of your overtime deduction basically, and it will come off of your adjusted gross income to arrive at your taxable income on your Form 1040.
Interesting. So with that being said, I'm curious, and again, I don't know how accounting systems in general, but particularly the foundation is going to handle this. I've got to wonder if we don't do anything with the taxability of those overtime earnings and put that as a filing burden on the employees, basically just being able to report to those employees, here are your eligible overtime earnings that you can then deduct from on your tax return, which of course, if it's over 12.5, they would only be able to take the 12.5 limit.
I think that's how it's going to work because it's just the income tax too. It's not Social Security, Medicare, and all that. That's still getting paid on both sides. You're going to give them the information of how much of it they got paid, right? And then they go in, they take the deduction on their personal tax return.
Yeah.
12.5. So that's and again, like Leslie said, it's going to evolve in the reporting on this because it's going to be the Wild West this year. But that's going to be the intent. Payroll run like normal. You're probably whether or not you're going to do the withholding or not. I'm trying to figure out that piece. I don't on the federal tax. I don't know about that. But then they'll be on them to file that return.
Yeah, it's interesting because again, programmatically, I can't see the feasibility of doing this calculation each and every week. I mean, then of course, even trying to cap it out and say, well, in the middle of this week, you hit that 12.5. Now we have to tax everything. That would be very complicated and very prone to errors, I think. So I think just in general, calculating how much premium earnings were paid in a given period is probably going to be the end solution. But
I can see both sides of it too. I mean, if you don't get if you don't change your withholding, it's going to be a larger refund at the end of the year, which is not great for the economy in terms of that money going right back in the economy, but it's also can be a savings there, but it also gives the government that use of funds too. So
Yeah.
And given the complexity of it and the propensity for error, like you mentioned, my guess is it's not going to be adjusted every week, but I could be wrong.
Yeah, I'd say year-end tax filing is probably in line. So basically, just expect a big return, or adjust your withholdings to lower those with that anticipation that there will be overtime dollars and credits. But what about this? Is the retroactive overtime from 2025 starting from when the bill was passed in July 4th, or does that go back to the beginning of 2025?
My guess is it's going to be the entire year. I didn't see anything saying it was only for wages earned after that date, but I've not seen anything specifically about that.
No, I haven't either, because I think it will just come over as kind of a flat deduction on your personal return. So from everything I've seen, there's no need to kind of bifurcate the year.
Yeah, it's just going to be the whole year 25 that shows up on your W-2 reporting, right? Like how much overtime did you get this year? Because you talk about errors and issues, trying to go back and bifurcate that too. I mean, that's going to be more complicated.
Yep. Last question I'm seeing here is, how will the government shutdown affect filing taxes or getting through to the IRS? And I can tell you, getting through the IRS has been a nightmare without a shutdown. I can't imagine it's any better with a shutdown.
Yeah, going back to COVID, I mean, it's been terrible. I mean, used to we had the practitioner hotline, we could call them and get through pretty good, and that's been a disaster. And you have to get up pretty early in the morning to be the first one on the phone. I know Leslie, I've talked to her 4 different times in a day, and she's still been on hold with the IRS. I mean, it's very difficult. It has been since COVID. It's going to get worse now. And how long it will take to correct to just how bad it was before the shutdown, I don't know, and how long it's going to take to get back to where it needs to be, I don't know. But I would expect delays in refunds, delays in phone calls, delays in response. I mean, we'll get a notice, we'll respond, and our clients will get 3 more notices before they ever open our response on the first notice, and we've got to call them on the phone before they ever open the mail from our first response. So the answer is it's bad and going to get worse, and how bad only the government knows.
Yeah, Mark, and I was just reminded. I was having a conversation with our tax operations director here at the firm a couple hours ago before this webinar, and she reminded me that tax filing season for the 2025 season is not opening until February 16th. That's the date that the IRS is set. And so, I mean, there will be some ability to file returns before then, but they won't begin processing 2025 returns until February 16th. And that's about 15 to 18 days later than any start date that I've seen in my career. So, again, we're going to be dealing with a compressed tax season, and people are going to be getting their refunds later. So, and it's related to the new tax legislation, and the shutdown that's happening now is not going to help either.
Yeah, and think about all the software updates. Just just think about foundation side, what they've got to do for payroll and all that. Think about every tax provider out there is using a different tax software. All those softwares have to be updated. Your payroll software's got to be updated. Your accounting software's got to be updated. The IRS isn't ready for this stuff, and they're already understaffed, and and they got to shut down. So there is no telling what we're in for, but I'm not expecting it to be smooth by any means.
Most things aren't when it comes to the IRS, that's for sure. So there's one last question, and then we're pushing 2:30 here. So I appreciate everybody sticking around as long as they have. I knew there'd be a ton of questions, and it's really great. But this question is on trusts. Are there any changes?
I could just kind of speak a little bit to that. I do kind of dabble in trusts and estates a bit and have some knowledge there. There aren't any direct changes as far as the one big beautiful bill. What could affect some of your trusts are the increase in the estate tax exemption, and also the trust rates, the trust income tax rates that mirror the individual tax rates, that was also made permanent as well as part of the one big beautiful bill. But other than that, no major changes specifically for trusts.
Good. There is one that just did come in here. It's asking about the exemption being on just the half of the time and a half, not the entire overtime rate. And something important on that to consider is also on the double time. It's not the extra 1 hour, it's just the extra half. So it's really only exempting the extra half hour of pay on any overtime, whether it's overtime or double time. So basically, what is that? 1/3 of the time and a half and 1/4 of the double time. Is that math correctly? Sounds right.
I think so, yeah.
Yeah. Look at that. I knew there was a reason I had in this job. I can deal with simple fractions. All right. Everybody, there are 154 of you still online. I definitely appreciate all of you sitting here with us this long. Leslie, Mark, so much appreciate the time and effort put into this presentation. I know it's a lot of prep work, and we really both appreciate both of you taking the time to present here for us today. Again, to the attendees, all of you for sticking around and being so engaged. There's a lot of great content, a lot of information, and also, unfortunately, a lot of unanswered questions because we just don't know, uncertain. But that's all we've got for today. The QR codes here for getting in touch with Adams Brown. We got the online as well as the LinkedIn QR codes. Obviously, we have the contact information here for Mark and the phone numbers. So, questions, definitely reach out. And the recorded session will be emailed out to the email that you used to register for the session within 48 hours of the presentation here today. It takes some time for GoToMeeting or GoToWebinar to process it before we're able to actually send out the link. So that is all we've got.
Ron, thanks for having us on. We appreciate it. And if you have any questions, feel free to reach out. We'd love to help, love to connect with you on LinkedIn.
Absolutely. Thank you both.
Thanks.
Take care.